Most people believe markets react to news in a simple way. Good news pushes prices up, bad news pushes prices down. But that's not how experienced capital actually behaves. Markets don't fear bad news. They fear what most people haven't noticed yet. If fear alone moved prices, the biggest rallies would always happen during crises. Yet some of the strongest moves in history occurred when headlines were calm, growth looked stable, and confidence appeared intact. That disconnect is where many investors get confused. They look for drama. Institutions look for imbalance. Large pools of capital are not trying to predict the next headline. They are responding to slow, structural shifts that don't fit neatly into daily news cycles. By the time those shifts become obvious to everyone, most of the repositioning has already happened. This is why focusing only on sentiment or short-term narratives can be misleading. Price is often reacting to something deeper, changes in incentives, constraints, or risk management behavior, long before the public explanation catches up. So instead of asking whether the market feels optimistic or fearful, a better question is this: what has quietly changed beneath the surface that alters how capital needs to be positioned? That is the lens we'll use here, not to generate urgency, not to predict headlines, but to understand what the market is responding to before emotion enters the equation. Over the past year, the gold market experienced an unusually strong and persistent price advance. During 2025, gold rose by more than 50% on a year-over-year basis, marking its strongest annual performance since the late 1970s. Over that same period, gold recorded a large number of new all-time highs, reflecting sustained upward momentum rather than a single short-term spike. The pace of the move accelerated in the second half of the year. Average prices trended materially higher in the fourth quarter compared to the first half, and gold entered early 2026 near record levels. In January 2026, prices briefly reached a new all-time high before pulling back modestly. That pullback occurred without a sharp reversal in broader financial markets and without a corresponding collapse in demand indicators. Importantly, this price behavior unfolded during a period when U.S. equity markets also posted strong performance. Historically, gold's strength has often coincided with equity stress. In this case, both asset classes advanced over the same time frame, which is relatively uncommon and suggests that gold's move was not driven solely by short-term fear or market panic. On the institutional side, major financial institutions updated their outlooks following these price moves. In January 2026, Goldman Sachs raised its end of 2026 gold price forecast to approximately $5,400 per ounce, explicitly framing this figure as a forecast rather than a ceiling. Separately, J.P. Morgan published projections indicating a base case expectation of roughly $6,300 per ounce by the end of 2026, also emphasizing that this represents an estimate under specific macroeconomic assumptions, not a guaranteed outcome. At the same time, official sector activity continued to show elevated levels. Data compiled by the World Gold Council confirms that central banks have purchased more than 1,000 tons of gold per year for several consecutive years, a marked increase compared with the decade prior to 2022. Survey data further indicates that a majority of central banks expect global gold reserves to continue rising. Compared to 1 month earlier, the primary change is not a reversal of trend, but a consolidation near historically high levels. Compared to 1 year earlier, both price levels and institutional positioning appear materially different, reflecting a shift in how gold is being treated within global portfolios. To understand why recent developments in gold matter, it helps to move beyond headlines and focus on how capital responds to structural conditions rather than daily news. Price changes are rarely isolated events. They are usually the result of a sequence of incentives and constraints that affect different market participants at different times. At the first order level, gold responds to changes in monetary conditions. When real interest rates, currency stability, or long-term purchasing power become less certain, gold tends to be reassessed within portfolios. This reassessment does not require a crisis. It occurs whenever traditional stores of value are perceived to carry higher long-term risk, even if short-term performance remains strong. Second-order effects emerge when this reassessment is not limited to private investors. Central banks operate under different constraints than individuals or asset managers. Their mandate prioritizes liquidity, resilience, and neutrality rather than return maximization. When official institutions adjust reserve composition, they do so gradually, but at a scale that can materially influence supply-demand dynamics over time. The impact is cumulative rather than immediate. Another key transmission mechanism is portfolio construction. Gold is not typically purchased as a standalone bet, but as a balancing asset. As correlations between equities and bonds become less reliable, gold is increasingly evaluated for its role in reducing overall portfolio volatility rather than for short-term price appreciation. This changes the nature of demand from tactical to structural. The timing of these effects also matters. Institutional allocation decisions are often implemented in phases, governed by risk committees and rebalancing schedules. As a result, price moves may continue even after initial catalysts have faded from public attention. This can create the impression that gold is moving without a reason, when in reality it is responding to delayed capital flows set in motion months earlier. The distribution of impact follows a predictable sequence. Official sector buyers and large institutions are typically the first to adjust. Professional asset managers follow as allocation frameworks evolve. Retail participation historically lags both groups, not due to lack of interest, but due to the absence of clear narratives and benchmarks. By the time gold becomes widely discussed as a mainstream allocation, a significant portion of the adjustment has often already occurred. This chain reaction helps explain why recent gold strength has persisted without extreme volatility. It reflects gradual repricing rather than speculative excess. Whether that repricing continues depends not on sentiment, but on whether the underlying conditions that prompted reassessment remain in place. Understanding these cause and effect relationships is critical. It shifts the focus from short-term price moves to longer-term structural behavior, which is where durable trends tend to originate. Periods of strong gold performance are often remembered in simplified terms. A crisis happens, gold rises, and the story ends there. In reality, the conditions that precede sustained moves in gold are usually more gradual and less dramatic than the outcomes that later define them. One of the most frequently cited historical comparisons is the late 1970s. In the years leading up to gold's peak in 1980, the defining features were not a single shock, but a combination of prolonged monetary expansion, rising inflation expectations, and declining confidence in fiat currencies. Importantly, gold began its ascent well before inflation reached its most visible levels. The market was reacting to policy direction, not just reported data. Another relevant period is the aftermath of the 2008 financial crisis. Gold did not peak during the height of the crisis itself. Instead, it continued rising for several years afterward, as unconventional monetary policies became normalized and balance sheets expanded across major central banks. The key similarity was not fear, but uncertainty about long-term monetary outcomes. More recently, the period following 2020 introduced another comparable setup. Extraordinary fiscal and monetary responses altered the scale and speed of money creation globally. Gold responded, but in a more measured way than in prior episodes, partly because alternative assets and financial innovations competed for attention. The absence of immediate crisis conditions delayed broader recognition of the shift taking place. What is different this time is the composition of demand in the institutional backdrop. In earlier cycles, private investment demand dominated gold flows. Today, official sector participation plays a larger and more consistent role. Central bank purchases at current levels have few historical precedents outside periods of major monetary realignment. Another difference is market structure. Gold now trades in a far more liquid, globally integrated financial system. Information travels faster, hedging tools are more accessible, and portfolio decisions are increasingly rules-based. This reduces the likelihood of sharp, singular blow-off moves, but increases the probability of extended repricing phases. History in this context is not a template for prediction. It is a filter. It reminds us that gold's most significant moves have tended to begin before consensus narratives formed, and that the conditions leading up to those moves were often underestimated at the time. The past does not tell us what will happen next, but it does help us recognize when the present is being misread. At this stage, the most useful way to think about gold is not in terms of a single forecast, but through scenarios. Professional risk management is less about being right and more about understanding what must change for different outcomes to occur. What follows are not predictions, but conditional frameworks. Bull case, conditions for continued strength. If current structural forces remain in place, gold could continue to reprice higher over time. In this scenario, several conditions would need to hold. First, monetary policy would remain accommodative in real terms. This does not require aggressive rate cuts. It simply means that inflation-adjusted yields remain low or negative, keeping the opportunity cost of holding gold relatively contained. Second, central bank behavior would continue along its current path. If official sector purchases remain elevated, particularly among emerging market central banks seeking to diversify reserves, this would provide a steady, price-insensitive source of demand. Importantly, this demand is not driven by momentum, but by policy decisions. Third, portfolio construction models would increasingly incorporate gold as a volatility dampener rather than a tactical hedge. Even modest increases in strategic allocation, applied across large pools of capital, could have outsized effects due to the relatively inelastic supply of physical gold. Under these conditions, higher prices would be a function of gradual reallocation rather than speculative acceleration. Base case, stabilization with structural support. The base case assumes that current trends neither accelerate nor reverse sharply. In this scenario, inflation moderates but does not return to pre-2020 norms. Growth slows but avoids recession. Financial markets remain functional and risk appetite persists. Gold prices consolidate near elevated levels, experiencing periodic pullbacks but maintaining a higher trading range than in previous cycles. Central bank purchases continue, but at a slower pace than recent peak years. Institutional investors maintain existing allocations rather than aggressively increasing exposure. Retail participation remains selective. Here, gold functions less as a momentum asset and more as a structural component within diversified portfolios. Price movement is driven by rebalancing flows and macro data rather than sentiment swings. This is typically the least discussed scenario, not because it is uninteresting, but because it lacks drama. Historically, however, it is often the most common outcome. Bear case, what would change the trend decisively? For gold to enter a sustained downtrend, several key conditions would need to change meaningfully. Real interest rates would need to rise and remain elevated. This would likely require both restrictive monetary policy and durable disinflation, restoring confidence in cash and fixed income instruments as long-term stores of value. At the same time, central bank demand would need to slow materially or reverse. This could occur if reserve diversification pressures ease or if confidence in existing reserve assets improves. Without this official sector bid, gold would rely more heavily on private investment flows. Finally, correlations between traditional asset classes would need to normalize. If stocks and bonds reliably provide diversification again, the portfolio rationale for holding gold diminishes. Under this scenario, gold would likely retrace part of its recent gains. Importantly, this would not imply failure or crisis, but a reassessment of relative attractiveness under different macro conditions. Thinking in scenarios forces discipline. It replaces certainty with conditions and emotion with structure. When markets enter a structurally driven phase, price alone becomes a poor guide. The more reliable signals tend to come from indicators that reflect incentives, liquidity, and positioning rather than headlines. These are the areas I monitor most closely. First is the US dollar index, DXY. Gold does not move tick for tick against the dollar, but prolonged dollar strength or weakness materially affects gold's relative appeal. A stabilizing or weakening dollar environment, particularly against a basket of major currencies, tends to reduce friction for gold demand at the margin. Second are real interest rates, especially long-dated treasury yields adjusted for inflation expectations. Gold historically responds less to nominal rates and more to real yields. Sustained moves in real yields often precede changes in gold trends rather than follow them. Third, I watch inflation data, specifically CPI and PCE, not as single data points but as trends. Markets react to direction and persistence, not just monthly surprises. A slowdown in inflation that remains above long-term averages has different implications than a rapid return to pre-2020 levels. Fourth is liquidity and positioning. Futures market open interest, ETF flows, and changes in institutional exposure provide insight into who is driving marginal demand. Sharp increases in leverage tend to signal short-term risk, while steady, unlevered flows suggest structural allocation. Finally, I pay attention to cross-asset behavior. When equities, bonds, and gold move together, it often reflects liquidity-driven conditions rather than asset-specific narratives. Divergences between these markets can be more informative than isolated price moves. None of these indicators provide certainty on their own. Their value lies in how they interact. When several begin to align, they offer a clearer picture of whether current conditions are reinforcing or undermining gold's role within the broader system. This process is not about reacting quickly. It is about observing consistently. At this point, the most important takeaway is not where gold might trade next week or next quarter. It is understanding why the market is treating it differently than in past cycles. What we are seeing is not a reaction to fear, but a response to structure, how capital allocates when long-term assumptions begin to shift. That kind of change happens gradually, often without drama, and usually without clear signals for those looking only at headlines. None of this removes risk. Prices can correct. Conditions can change. Assumptions should always be tested. That is why patience and position sizing matter more than conviction. Gold does not need to be viewed as a bet, but as one component within a broader framework that prioritizes resilience over prediction. This isn't investment advice. It's simply how I'm reading the market right now, calmly, conditionally, and with respect for uncertainty. Long-term thinking has always mattered more than short-term noise.